and we'll give them one.
Hi, everyone.
Hi, we're just going to give everyone a couple minutes to trickle in here.
I see a lot of familiar names. I wish I could see your friendly faces. Let's see. I see folks from all over the place. I see my Barstow friends. Shout out to Barstow. Oh, here's my Marfa friends. Look, I even have my LSL friends. We'll give just a couple moments for everybody to log in. Yeah.
Definitely.
Hi, American Canyon. I can see you. I'm only in the J's. That's how many people we have. I see my LACDA friends too.
All right, more and more people are hopping on, so.
We're just waiting for the count to slow down a little bit, folks. Let everybody get in. There's a pretty big queue that's all connecting in at one time.
All right, well, I'll go ahead and get started and welcome everybody. Hello, and welcome to How to Implement GASB 96 and Maintain Compliance. We're so happy that you've joined us this morning. Before we get started, a few housekeeping items. This webinar is eligible for 1 hour of CPE credit. We will be launching 4 polls throughout the presentation. To receive credit, you must answer all 4 polling questions and also complete the short evaluation that you will receive afterwards via email. The evaluation email will be coming through a software program called Prolera. This webinar is being recorded, and you will receive the recording link and slides emailed to you later today. So be on the lookout for that in your inbox. This webinar will run for 50 minutes with 10 minutes Q&A at the end. And if you want to stick around for a DebtBook demo, be sure to stay on after the Q&A session. Please hold all of your questions until the end of the presentation. If you have a question, please put it in the Q&A box located in your Zoom toolbar. To find your Zoom toolbar, you'll just have to hover your mouse over the top or bottom of your screen and it'll pop up. Just look for the Q&A icon. Now I'd like to introduce you to your host, Kelly Telford of LSL. Kelly Telford, CPA, is a partner in LSL's Government Services Department and has over 18 years of experience in public accounting. Her background includes accounting, financial forecasting, budget development, public utilities, investment management, grant management, human resources, and information technology. As a government services partner, Kelly oversees engagements for a variety of nonprofit and governmental clients, providing auditing and consulting, often acting as an extension of their finance department. Prior to returning to LSL in 2022, Kelly served as the Director of Finance and Treasurer for the cities of Seal Beach and Costa Mesa. Now I'd like to introduce you to your presenter, Lewis Stratton of DebtBook. Lewis is the Managing Director of Strategic Partnerships at DebtBook. He is a certified public accountant who now works with innovative fintech companies to transform the lives of finance and accounting professionals. In addition to serving public sector clients in his accounting role and holding leadership positions at Blackbaud and Port Brown, Lewis also has served as an adjunct professor of accounting, auditing, finance, and management. All right, now I'm going to hand it off to Kelly, so take it away, Kelly.
Thank you, Cami. Appreciate that. Hi, everyone. It's so great to see all of you, at least see all of your names in the attendees. I see so many familiar names that are either my clients or that I worked with when I was a finance director. I wish we could see you in person, but I know with technology, it's so much easier to do webinars. So I really appreciate you attending today. We've seen so many changes with the implementation of GASB 87. And even just before this call, had a client that called me asking me about GASB 96. So we really wanted to put together an opportunity for you to learn and understand
So we'll pause for 1 minute.
the differences between GASB 87. Did I break up?
You froze for a second. I was gonna jump
my
in.
apologies. This has been happening only since I've been on this Zoom. It's been fine all day. So to the group, my apologies if I freeze for a moment. But I wanted to bring DebtBook in to do this presentation because they really are the experts. They see thousands and thousands of subscription agreements. And when we were going through the implementation of GASB 87, let's just say it was not easy. I think all 275 of you that are on this call can agree that it kind of sucked. We learned that we had underestimated the complexity of it. We learned that we had underestimated the time that it would take to extract all of the data necessary to implement. And what we want to take away as we move into the implementation of 96 is to prepare early. We're here in March. We're hoping that you're all pulling the agreements already. You're all looking and working with IT to be able to get a greater understanding of how many there are. And hopefully you're also looking into software solutions. I've had a number of our clients that have done the manual calculations for GASB 87 that kind of learned that it might be easier, just like fixed assets, might be easier to have a software solution do that heavy lifting for you. We also learned, document everything, even the ones that you don't think are going to apply to the standard. Make sure you at least document your consideration of them. That way, when we come out and do the audit, we have a better understanding of what you looked at. And then I'm going to plant this seed because we're just about to start our interims. Plan to be done early. Pull all the information. If you're using a software solution like DebtBook or one of the other ones on the market, get the information to them as soon as you can so that they can start. Most of our clients were delayed for 2022's audits because of the implementation of GASB 87, and it killed our people, it killed your people. So we're really just hoping to solve that issue and just prepare earlier. So what I'd like to do is, if I could go ahead and invite Lewis to start the presentation on the background of GASB 96 and what to look forward to. I really have looked to them to be the experts in this space. So Lewis, go ahead and take it away.
Thank you, Kelly. Good morning, everybody, or good afternoon, whatever part of the country you're in today. Before we get started, I'm going to give you a little bit of an overview. Kelly shared some lessons learned from GASB 87 and GASB 96. I want to make sure we all know what GASB 96 is before we get started. So as you know, with GASB 87, that was a change in the lease accounting rules. And you had to find all your lease contracts, present value of those, put them on the balance sheet, and you had to list them separately as a right of use asset with a corresponding long-term liability. GASB 96 is going to be the exact same thing, only it's going to be all your subscription-based IT arrangements. That's SBITA. And you're going to hear me say SBITA a lot today. And that's what I mean by that, subscription-based IT arrangement. There is no lessor equivalent. We're going to walk through some of that. I was at the Illinois GFOA last September, and they asked me to present on GASB 96. And while I was there, one of the first things I heard a speaker talk about was how the state, for the financial transparency, wants to create their own little website and place for people, for all the municipalities to publish their financial statements, and then they'd like to subscribe that back out to the local governments. And then they wanted to do the same thing for body cams with all the police departments in the state, where they would all have centralized storage, and they would subscribe that storage back out to the local governments again. So I left that. I came back to my office and I grabbed Casey Harris, who Kelly knows. And I said, hey, Casey, they said no less or equivalent, but I'm hearing these things that I wonder if they just had an oversight here and they didn't think about the possibility that it could occur. So Casey and our technical team called into the GASB. They researched it. When you do have things that might appear to be lessor type subscription-based IT arrangements, you're going to follow revenue recognition standards and not GASB 96. That's how that's going to apply. I'll share stories throughout. I am our DebtBook's presenter on GASB 87 and 96 around the country. So I pick up lots of little anecdotes and stories along the way that I'm going to share as we walk through the presentation today. And Kelly will chime in as she feels the need to or feels like she'd like to. So one of the biggest stories that I heard about GASB 87 was just the fatigue that people had after trying to look for all their agreements. And so people spent a lot of time looking for them. There were a number of horror stories. I mean, I heard stories like people had been paying on contracts for 20 years that didn't exist. And finance just didn't even know they didn't have a contract. So I think one of the positive things from these rule changes is that it's really forcing the finance function to take control of the contracts and the contracting process for leases, subscriptions, and really other contracts because of the embedded leases and things. So now you kind of can flex a little bit and say, hey, all of these agreements have to come to finance. We have to consider them and evaluate them to see if they fall under one of these regulations. I know when I was starting out, I used to like to say it's GAAP. Just don't question me. It's GAAP. You wouldn't understand. And you now can use something like that on folks to say, hey, we have to be involved in every contract so that we can go through it. So the first thing you need to do when you're planning for GASB 96 is you've got to have you got to have a plan, right? So you got to have a plan for success. You've got to identify all the things that need to be done. This plan will be available to you. There'll be a copy of this deck as well as this recording. So you'll have this plan that's here. And so this will we're going to walk through these 8 steps of what you need to do to implement GASB 96 and maintain compliance. So with this plan, you need to identify who it is in your organization or outside your organization that's going to be involved in each one of these steps, the timing of each one of these steps. I think we all know that whenever you are working on a project, when you pick it up and put it down, it's like if there's any lag in between, it's like you have to start over. So it's a really inefficient way of doing things. So it's important to make sure that when you're assigning staff or team members or champions, whatever you want to say, to each one of these steps, that they're not going to be on vacation, that there's not, there will be unforeseen emergencies and things, but you just want to try to plan for success by making sure that you're not scheduling people to work on a step that might likely occur during their vacation or something like that. So getting organized and having a plan is really important. Step 2, this is probably one of the hardest steps. It's finding and collecting all of your subscriptions. This is, I am hearing that IT people are more organized than we were on the leases, that a lot of IT people keep really nice, neat lists of all the subscriptions. So if you're a city or a county, this might be easier. I'm hearing from a lot of school districts that we don't have an IT person and we don't have a nice, neat list. And people are calling and begging for help on this. And what happens is after you go through and spend all of your energy finding all of these agreements, you will be fatigued. And yet that's only the beginning. You've got a lot of work to do. So these subscriptions are very similar to GASB 87. We kind of talked about that a little bit. But it's going to have to be a contract that conveys the control of the right to use another entity's IT software. And it has to be controlled for a period of time in an exchange or an exchange-like transaction. I think very similar to 87 there. New to subscriptions for 96 is, does the software contract contain a tangible capital asset? So again, I like to tell the stories. I'm sitting at the Florida CPA Society Government Conference. There's a panel. There's partners from CPA firms. There is a technical director from the GASB who'd been at the GASB for 25 or 26 years, something like that. And so they have this panel. There's also folks who were, leaders in finance at local government organizations. And somebody from the audience, and I didn't see who, said, hey, what about police body cams, right? So for software subscriptions, does it contain a tangible capital asset? Clearly, you're paying for the storage, you're paying for the software. And in this case, this person was subscribing to everything. And there's actually a hardware device and there's a battery pack. And the GASB guy who had been there for 26 years looked out and said, that's just a junk piece of plastic without the software. And the person said, no, this thing is expensive. And he said, well, is it mostly hardware then? And it should be under GASB 87. And they said, well, no, it's both. It's hardware and software. And so they came to the conclusion that in that circumstance, they might have to split that, where the hardware gets treated under 87. Maybe the hardware is 3 years, the software is under 96, and maybe it's a 10-year life or something like that. So that was the conversation that we had. So as you're going through GASB 96, you're going to be looking for things like that and saying, do we have to split that up? You also need to find out if it's a perpetual licensing agreement. Perpetual licensing agreements, you can't present value something that's infinity, right? Like it's tricky to do that. So you have to find out, is this perpetual? Or is there a definite time frame on this for a period of time, as we talked about up above? And then we have obviously similar stuff here for short-term contracts for GASB 96 as well. So next, we'll talk about something different with GASB 96 is now we also have these project costs that we have to track. And there's 3 types of projects that we have to track for the subscriptions. So initially, first you're going to have to look at each subscription and say, okay, what were the preliminary project stage costs? Those actually get to be expensed as incurred. We have some examples of those on the screen here. Like, do I need to determine if I need to buy a new ERP system? And if I do, the costs around making that determination and making a selection and evaluating and selecting the alternatives there, that's all expensable. Once I choose an ERP, then I'm going to have to keep track of all of my implementation costs. And, we're talking about coding, testing, installation. All of those costs are going to have to be tracked and then capitalized into that present value factor. So after you present value those subscriptions back, you'll have to adjust that present value for those capitalizable costs. And then you could have ongoing costs, so operational and additional implementation stage costs. And so you might add a module or a component to an existing technology that you have in place. And you have to be able to track all of those project costs and document those. You do get to expense them as incurred, but the standard then requires that you track those and attribute them back to that particular subscription. You have some other examples here of costs that should be incurred prior to the following, right? They're saying they should be expensed. So determination of the specific objective of the project and nature of the service capacity, demonstration of technical or technological feasibility, and then the demonstration of your current intent, ability, and your presence of effort around a subscription-based agreement. I have a polling question. If my colleague Connor will come on, and as we go through, you have to answer these polling questions if you're looking for CPE. So Connor will launch that. He'll read them to you with the alternatives, and then we'll discuss the results at the end of each question.
All right, I'll go ahead and launch it now here. All right, so the first question is, where are you in the process of collecting and organizing your subscriptions? Feel free to go ahead and answer here, and we'll give a couple seconds here for everyone to answer.
Connor and Lewis, while everybody's answering the questions, couple of little tidbits. On a previous slide in your step 1, you had talked about making sure that you assign a lead, a person who's going to be responsible. Some lessons learned from GASB 87. Finance doesn't really enter into leases, just like other than for the most part ERP, finance doesn't really enter into subscription-based IT arrangements. It's really important to make sure that you have a lead in finance, because finance needs to have some skin in the game. They're the ones who are answering questions. They're the ones who are responsible for the accounting standard implementation. And where I've seen successes and fails, the successful implementations have been where finance really takes responsibility. And the ones that I've had problems with, where maybe it didn't go as successful as we'd hoped, are the ones where finance had another department be the lead because of maybe the number of properties with that other department. So that's just a little bit of tidbit as you go through that. And I'll add, I have a couple of other notes that I'll add along the way as we do these polling questions, but just something to consider for the folks on the call.
Thanks for that, Kelly. And Connor, will you end the question and then share the results to the screen?
Yep.
It looks like about 22% have collected everything, and the other 78% have either not started or have only collected a few.
All right, I'm gonna go ahead and share the results here.
Not too surprising.
Yep. So
But I wish it was a little higher on the, we've already started collecting as your auditor, or at least some of your auditors.
yeah, I think, you know, one thing, as Kelly said early to everybody, not everybody actually had leases. Some of you only had a few leases. Everyone's going to have subscriptions, and everyone's going to have more subscriptions than they had leases. I had one school district that had 3 leases and they have 200 Sabitas. And so I think if you're a school district, you're probably going to get a lot. And if you're a local government, you're going to have, I don't know if you'll have more as a local government, but there's the potential to have a lot more subscriptions. So this is going to be a heavier lift. And so please don't wait till the end on this. I know with DebtBook, and you'll meet our colleague here later if you stay on for the second half of this, but you'll see that we ask for 90-day turnaround to get ready. So if your audit is at the end of June, if you know that Kelly's coming in August, you would want to have things, you know, to us by May at least, in order to be ready for the audit. So just to give you some idea of timing there. So I'll stop sharing and close the question and move on to the next slide. Once you've found all these subscription agreements, it's really important. You've got to go through and extract all the data. And so what all you're really doing is you're doing a present value calculation. And so we say 4 pieces of critical data here. There's a 5th one, it's the interest rate, but we break that out and talk about it later. So it's not included on this slide, but you really couldn't do present value calculations without that. So I'm going to discuss it here, but save the meat of that for later. We highly recommend that you use a checklist. And I think this slide deck will provide some more details around what you should be looking for as you go through your subscriptions. But essentially you need to find out, you know, in order to do that present value calculation, you need to know how many payments you're making. So what is that subscription term? You need to know the amount of the payment, right? And then you need to know the interest rate. That will give you what you need to do the present value calculation. And then you're going to adjust that for any payments that you made at commencement, those capitalizable implementation costs. Then you're also going to adjust that for these other prepayments or incentives that you received before commencement as well. So it's important when you're extracting this data that you find the people that were involved. As Kelly just said just a minute ago, is that finance isn't involved in all the subscription agreements. It's important to go find the people that were, so that they can help you extract this data and make sure there's nothing that you're missing. There's a lot of fine print. I think reading these agreements has got to be one of the, my company does it, but I'm going to say it's the worst job in the world. I don't personally read all the agreements, but that has got to be tedious work, is sitting there reading all of the detail of all these contracts. And so make sure that you have those people that were involved and they can help you find these critical components of information as you're going through. Now we're going to talk about each of those components as we in more detail again. So we're just layering down here. We're going to talk about the subscription term. So you may have a non-cancelable subscription agreement that is 36 months. It could have a 36-month extension option. And it's all about reasonable certainty with subscriptions, just like it was with leases. So the question is, are you reasonably certain? And then is somebody with the authority to be reasonably certain the one making that assertion? And then are you documenting that so that when Kelly comes in, she'll be like, okay, you guys are reasonably certain this is what you decided. If for some reason you were reasonably certain that you would not take it and you ended up taking it, you would have a disclosure to make later, and vice versa, right? So very similar to leases with regard to reasonable certainty. On extension options, if you were reasonably certain that you would take that 36-month extension, you would have a 72-month period that you would have to do your present value over. The same thing would work on termination options or fiscal funding and cancellation clauses. You could have cancelable periods where anybody could terminate at any time, and that might make it impossible to then do the present value calculation, meaning it'll become like a non-GASB 96 subscription, but you would have to document all of those things and put them in, as Kelly said, find the contracts, whether they're a GASB 96 subscription or not, and show that you've considered it and that you've gone through and documented, why you made your determination. I do see questions coming in. We are going to answer those at the end. Kelly and I'll come on and go through those together.
I'm working on some of them right now for you.
Okay, perfect. As we go through and look at the payments, you might have fixed payments, right? That's easy. We love fixed payments. That keeps life simple. It's a flat amount every month, maybe every quarter or something every year. That makes life really easy if we have that. You could have a variable payment. And that variable payment can be fixed in substance. It can be based on an index or rate. I don't know any IT agreements based on an index or a rate. They can be based on a future performance. One of my examples, and I'm going to bring this up a couple of times, I was giving this presentation at an ASBO, at a state ASBO, and somebody said, "Hey, Lewis, are you telling me that?" And this will come up later when we talk about multiple subscriptions on a single agreement. But they were saying, "Hey, are you telling me that if we have 22,000 people using Office 365, all those agreements start and stop when employees are hired or terminated, that I'm going to have to create 22,000 calculations?" My 90% of the time, my answer is always going to be to you, it depends. We have to read the contract. In this person's case, their perception of how this worked was contracts start when people are hired or terminated. So they're all unique. And that's how that would work. But when I started looking at the agreement, it was more of a variable agreement where you might have a base, think like copiers, where you pay a flat amount per month and that covers up to so many copies. Well, in this, Microsoft's not going to do 22,000 individual license agreements with an entity. They just want to say, okay, we're going to give you up to 20,000 people for this flat annual fee. And then if you exceed that, you're going to pay an incremental amount for the next, 1,000 or 2,000, right? So you get that stepped up amount. And since it's hard to predict, you may have a variable component there. And all you would do is use the amount that was known to you, not that variable portion that you didn't know. So a little bit, we have some of the language in this slide is from 87 that we're still talking about. But I think as we think about the types of subscriptions that I'm seeing out there in practice, those are some good examples of variable. You might have a data storage environment that you pay a flat amount for so much data storage. And then if you exceed that data storage amount, you have to pay per gigabyte as a variable component. Those are the things that you might run into on your subscription agreements that would be out there. And you may also have to pay some termination penalties or any contract incentives that you might receive, or any other kind of payments that you'll have to consider in this calculation. All right. Other types of payments and costs, you may have made payments at commencement. That'll be included as an increase in your subscription asset. If you had capitalizable implementation costs, if you remember, there's 3 types of projects. Those capitalizable implementation costs are going to be included as an increase in the subscription asset. You may have prepayments or incentives that you received before commencement. And so you would have to take any prepayments minus any incentives that you receive before commencement, and that's going to either be an asset or a liability prior to commencement. You may have to reclass an asset or a liability to a subscription asset at the commencement date later on, once you get everything put in there. This is where we're going to talk about that agreement again on those Office 365 subscriptions. You could have multiple underlying, just like with leases, you could have had 100 copiers on a single contract. If they had the exact same term, it was treated as a single present value calculation or a single agreement. If they're all on separate terms or start and end date, you had to treat them all separately because you had to do the calculations separately. And this is where I got asked the question, hey, I have 22,000 Office 365 agreements. And the answer is no, you don't. You have one agreement for up to 20,000 users, and that one agreement starts and stops on these dates. And then if you go over that, there's a variable portion. One thing I'm telling folks is if you have subscription software and maybe it's on account, maybe you subscribe from June 30 to May 31 or to whatever. Yeah, July 1 to June 30. So you have like a June 30 year end type of a subscription, but maybe kind of like middle of that in December sometime, you add a module. And so that gets put in there. Call your vendors, prorate everything, get it on a similar subscription basis so that it is not necessarily separate contracts, separate invoices. Try to clean that up some so that you don't have to have issues around that. I think there's some opportunities. As I pivoted away from public accounting and got into the software world, most software companies are willing to do some prorated billing to get everything on the same term if they need to. Non-subscription components, I don't have great examples here on this. And I in the old days with certain software, you might have, different maintenance agreements and things like that. You might have some costs that are not related here to your subscription. So you just have to look at this and say, okay, what are the non-subscription components? And you have to break those out. It's a lot like non-lease components where you might have maintenance or warranty type stuff or here separate perpetual licensing agreements for things. Those have to be treated separately. So you might have for each of your subscription agreements, you're going to have this right of use intangible subscription asset that you're going to have to present separately from your leases and your capital assets with a corresponding long-term liability. You may also now with the subscriptions have this non-subscription component that you're going to have to amortize as well. And you have to break that out. If the contract breaks it out, that's great. It makes it easy. It's very unlikely that it will. I can't think of too many that would break that kind of thing out. They might. But if they don't, it's your job to go out and look at the best fair market value information, try to allocate that cost between the subscription component and the non-subscription component. And then if you can't do that, you can treat it all as a single component. You just have to justify to your auditor that you did try to do that. As they read through those agreements, they'll see, hey, there's a non-subscription component here. What did you do to try to find the information to break that out separately? So just be familiar with that and be aware that that's something you'll have to possibly do. All right, you found all of your contracts. You were wiped out, fatigued, but you had to keep pressing on. And now you had to read all of those contracts and extract all of the data. So you found the term, you found the payment, you found the interest, which we haven't even talked about yet. You tracked all those project costs separately. And then you did your present value calculations. And that's what this is. This is an example of your subscription liability and your subscription asset here on the screen. And what you had to do is discount those payments using the appropriate interest rate to get that beginning balance. And then you have to adjust that beginning balance for any payments that you made at commencement, any of those capitalizable implementation costs, incentives, prepayments, any of that stuff. Next, I'm going to talk about materiality. So everyone wants to say, everybody want to tell me their leases weren't material. And that was great. But the auditor is responsible for assessing materiality when they're providing assurance to readers of the financials. And they have a long formula that they have to calculate. It's a combination of inherent risk, control risk, and some other things that they bring in. And then they apply that percentage to total assets, total liabilities, income, and they come up with an aggregate number, and they have to bring in themselves, and it's also based on the auditor's professional judgment, some of this stuff, but they have to bring in and figure out materiality themselves. They can't do that if the information's not all there. I like to tell accountants that are working for an individual entity or organization that it's your job to try to get the books to the penny, and it's the auditor's job to provide assurance that those are materially correct. And that materiality threshold doesn't then become, some like margin of error that internal accountants can use to just say, oh, I can get the books within this and it'll be okay. You ideally are supposed to keep your books 100% perfect to the penny on behalf of, the citizens of your communities or, whoever you're serving. And it's the auditor's job to provide that. But I can tell you a couple of other things. Materiality is not the individual capital asset threshold. So you say, hey, we don't capitalize things under $5,000. Well, that's not what this is. It's everything in the aggregate that has to be all added up to determine if there's any kind of materiality. I had one of my clients who was the CFO for one of the 10 largest cities in America said, hey, I just stepped into this role. And my predecessor had been saying that our leases are immaterial, but we have an NFL stadium that we lease out to an NFL team. And she's like, I'm pretty sure that's going to be material. And I would agree with that. I'm sure, that the budget there was huge, but that seems like it had to be a pretty material arrangement. So again, I think, Kelly, I'll pause here and see if you want to chime in on this, but my push for you as a clients out there is you should try to get it to the penny and let the auditors have room on materiality.
So I'm going to give you my auditor answer, and I'm going to give you my finance director answer. So if I'm putting on my auditor hat, 100%, just get the accounting right. It's just like if you're accruing an AP invoice. Usually we have a process where you're accruing AP up to a certain point and you're accruing everything that needs to be accrued back. Now, after that certain point, you might have a threshold where you're only going to accrue things up to $10,000. But at the beginning, you're doing everything. That's my auditor answer. But for those of you who know me well, I like to wear my finance director hat a lot too. And I'm seeing some of the questions in the chat where there's hundreds of agreements and and you're right. The volume is crazy. The problem is,
Kelly, you froze.
oh, am I back?
Yep.
Okay. It looks like it's just like a blip and then I come back. So hopefully it stays that way. You've got to consider all of the accounts. In a future slide, you're going to go through the journal entries for it. And materiality exists and is tested at every account balance level. So you can't just say the asset part is material or immaterial. You've got to look at the liability. You've got to look at the impact on the income statement. My finance director hat wants to say, use immaterial if it's going to be maybe 1 year past the current fiscal year. If you know you only have 2 years under contract, and in this example, 5,800 is totally small. Okay, I could probably get behind that on the finance director side because it's a 1 year, one-time determination of immateriality. But don't use it long-term, and certainly don't make that determination globally. Make it maybe 1 or 2 that you make that determination, because you have to look at the aggregate from a materiality level. So to Lewis's point, use the hat with extreme caution, because what you don't want is an internal control finding because you missed a ton of these.
These examples are going to be here. I'm going to move to the next slide. Here's an example of how you can calculate your present value in Excel. So once you have this information, here we haven't even talked about rates yet, but the 5% interest rate, 24 months, a $5,000 payment. And then if it's at the end of the period, you would put a 0 in, or if it's at the beginning of the period, you'd put a 1 in there. And that will give you that calculation, which you would then adjust for any of those additional payments or capitalizable implementation costs. So super easy to just do that in Excel and then start to build those tables out. But that interest rate is where people get stumped, because if you remember from 87 and 96 is identical, you're required to use the stated rate, which means, does your contract have a stated interest rate? Well, I don't know too many subscription IT arrangements that are going to have a stated rate, because nobody in IT ever even thought that this was a financing arrangement. They just said, hey, this is an annual subscription. And so it's a different model. So there's unlikely you're going to find a lot of stated rates in IT agreements. I had one person all last year that said they had a lease with a stated rate in it. Next, you're supposed to move to the implicit rate. I think that's going to be almost impossible for anyone to calculate on Sabitas. So there's just not going to be enough information to do an implicit rate, which is going to lead you to the incremental borrowing rate. As part of attending today, DebtBook has an incremental borrowing rate calculator that we've prepared. That'll be included to LSL with the resources from today's presentation. They can distribute that to you. It allows you to go in, put in your credit rating, put in the start date and end date of your subscription. And then we have used an average cost of money during those windows of time for the dates on those subscriptions, along with an average margin to the financial institutions. So it's a very scientific calculation. Most CPA firms are like, yeah, this is a great method for doing this, and this is helpful. I had a couple of national banks call me and they're like, Lewis, why do our clients keep calling and asking us for interest rates on lease contracts? And I said, well, let me show you something. And I sat down and they're like, we absolutely cannot do this. They're like, we have to send them to underwriting and go through this whole process to see if we're going to quote them a rate. Like, there's a lot of legal involved. And they're like, we absolutely cannot be providing rates for people to get their present value calculation on leases. They're not going to do it for you on subscriptions either. And so there's a number of banks out there that have said, why is this happening? And I'm like, it's because CPE instructors are saying, call your bank, they might help you. And some banks did with one or two, but they were really not happy when they were getting calls and asked to find rates on, 10, 20, 100 contracts for leases. They don't want to do it. So you'll get that calculator. It'll be there. And we're happy to share that with you so you can try to attempt this on your own as well. So just know this has been one of the harder things of 87 and 96. And I think the calculator simplifies it. So you've done all that. You found your interest rate. You've done your present value calculation. You've adjusted it. You've built all your tables. Now you need to set up a review team and go through and review your work. And you really need to make sure that you give yourself 2 to 3 weeks on this, or plenty of time. I'm going to say 2 to 3 weeks would be relevant, depending on the number of Sabitas you have. This is important. You need to identify who's going to be on this team. You need to know that they're familiar with the GASB 96 standard, and that they're qualified to go through, review these agreements. So they need to be familiar with the agreements. They need to be familiar with GASB 96. And it's unlikely you're going to get through your first self-review without finding anything you want to change. So give yourself plenty of time to make updates and changes to your work, right? You also might want to use an outside consultant or somebody who can come in and look over what you've done to assist with all of those things. So with that, we have our next polling question, Connor.
All right. Let me go ahead and launch it now. So have you identified who will be performing internal review for GASB 96 compliance within your organization?
Hey, Connor, maybe we can answer a couple of these questions while we're waiting for the attendees to answer the polling question. I marked a couple in the chat to answer live because I know they're not applicable just to the person asking, but probably to the whole group. One of the attendees is asking about the volume of IT agreements and basically the effort, exactly what we talked about, the effort that it would take to pull all of these agreements. IT saying that they're short-term, less than 12 months, it wouldn't apply. And the attendee is asking, would it be reasonable to take a sample? I'm certainly gonna put the finance director hat on and say, absolutely. Do not ask them to send you all of that information. But I'll also put the auditor hat on and say, hey, that's a good internal control process to put in place. It's okay to give the responsibility to the IT department if you've educated them. But then you're performing that additional due diligence to verify that they understood and that you didn't have any anomalies. And of course, if you do find some, you need to expand that sample and verify even more just to make sure that it isn't a prevalent issue. So it's totally fine to take that approach if the volume is super large, especially for some of our counties. I see some of our county folks on the call today, so I think that would be reasonable. Do you want to close? Are we ready to close the poll? Do we have enough people
Yeah, I
responding?
think we're ready to close the poll and see the results, Connor.
All right.
So this question, Kelly, was, have you identified who will be performing your internal review for GASB 96? So that review process. And I think the majority of people, well, it says 55% of the people have said yes. And then that leaves us with about 31% of the people no, they don't have the personnel. And then 14% said we've identified them, but there's just no time. We don't actually have the time to prepare for it.
Not surprising. Go back to, I know we don't want to go back to the finance department and assign that finance person, but really see if you can separate somebody out. Even if you've got to bring in some temporary help to be able to bridge that stopgap. I know a lot of you, I see the familiar names. You've sat in on some of my other presentations about how to do more with less people. Really look at those options because it is critical for finance to be a part of this solution.
All right, our next slide is going to be about the journal entries. The journal entries are not going to be that tricky. They're pretty simple. But they are going to be susceptible to auditor scrutiny. This is where your auditor is going to come in. They're going to look at your GL. They're going to see these entries and they're going to drill into all those other schedules that you had prepared. And that's when they're going to start really looking at what you did for GASB 96. So this is sort of like the tip of the spear for the auditor. When they're looking through the GL, they're going to be looking for these entries and having a look. There's some examples here on the screen of the full accrual and the modified accrual entries. You'll have this deck, so you'll be able to look at these, but again, not really complicated, but important. Now it's time for our next polling question.
All right, next one. All right, so do you plan to engage an external consultant to assist with review?
I guess I could answer another one of these questions while we wait for the polling question. I want to answer one in particular because I was going to bring it up in an earlier slide. There's an attendee asking the question about a software implementation. And Louis, you had a slide up that showed the hard costs of implementing a software. And it talked about, in fact, on my side, I'll go to it. It talked about preliminary project stage, initial implementation stage, and the operation and additional implementation stage. And the question is whether or not we need to go back and capitalize those costs. And I almost brought this up, but then I didn't want to take up too much time, but now I think I need to. So that slide that Louis had up is verbatim out of GASB 51. I'm totally nerding myself out right now. But that was one of my favorite GASBs when I was a manager. It talks about intangible assets and when you capitalize intangible assets and when you don't. And this was back in the heyday before subscriptions came around, where you were purchasing licenses and you had a lifetime right to use that license. It was an intangible asset. So for the attendee who's asking the question about whether or not you would need to capitalize those, if they were material, they should have been capitalized. even pre-GASB 96, they would have fallen under GASB 51 as an intangible asset. Now with GASB 96, they fall under SPIDAs instead of intangible assets. So probably want to do a little bit more due diligence. If you're an LSL client, call me. If you're not, you could probably still call me. I don't mind. But on that particular one, make sure you take a closer look at that. See if it's material. If it's not, then don't worry about it retroactively. Worry more prospectively.
All right. And with that, I'm going to go ahead and end the poll and share the results.
All right. So about 34% not sure, 33% are an absolute yes, 18% no, it's not in the budget. And 15% no, we're confident that we got this. So I will close that one out and we'll move to the next one. I'll speed up a little bit. We're running a little behind. Let me close that. Next, you're going to have the note disclosures that you need to prepare. And just like with 87, these are going to be pretty similar to those. You need to include a general description of the SPIDAs with the basis, the terms, conditions, without the variable payments, the variable payments that were not included originally are going to have to be disclosed in there as well. You're going to have to list those right of use subscription assets separately from your other capital assets and your leases. Outflows recognized for other payments not included in the subscription liability initially. You're going to have to do those principal and interest requirements to maturity. So those 5 individual years along with the 5-year groupings thereafter, any commitments you had before commencement, and then any loss associated with impairment. This is the last really conversational slide that I have. I like to share here a little bit of history. I started my career in 93. My first boss was 58. I was 22. The technology at the organization was old. It was green screen, which if you're young, you probably don't know what that is. I still did accounting accruals on green accounting paper. I had to add them up with my 10-key calculator twice and tear the tape off and tape it to the green accounting paper and present it to him. And I was like, hey, man, there's a thing called a spreadsheet, because spreadsheets were out back then. They were around. And he's like, I don't trust the computer. So he would not let me use spreadsheets because of, he didn't trust it. Finally, I convinced him to let me use spreadsheets, and he still made me add them up with my 10-key and put my calculator tape on my spreadsheet printout for him. But the point of it is that, in my career, I went from green screen to DOS to Windows through Y2K into the cloud. And there's just been a what they call digital transformation. And doing Excel versus green accounting paper is a great example of how that automated the addition of columns and rows. And there's things you can do to check your work. And now Excel, or not Excel, spreadsheets, we will say, have become overused. I think if you Google how many spreadsheets contain errors, it's going to come up and tell you more than 90% of all spreadsheets contain errors. So people, have lost some trust in those. It's important as you're doing this SPIDA work, right, that you find all of your contracts. You've got to round them up. You've got to have an organized method for documenting what you did, so you don't have to rewrite the book report when Kelly's coming to do the audit of this was how I did SPIDAs. So if you track all of that as you're going through it, you document your processes. In the old days, for that old boss of mine, I would have put each separate contract in a separate manila folder. I might have filed them alphabetically in a fireproof file cabinet, and I might have listed each one of them out on a green piece of accounting paper that got put in a ledger book. And then anytime somebody asked, I would be able to pull the ledger book, say, yes, we have this. Here's the start date, the end date. I would have had all the details and information documented out. You could do it in a spreadsheet where you might scan and put all of those SPIDAs on a drive in your office or on a cloud storage. But there's also software out there, and DebtBook is one of those softwares. And the next hour or next 30 to 45 minutes after we wrap this up, one of my colleagues, Bill, is going to come on and he's going to present a demonstration of DebtBook. But for those of you who are interested, it just allows you to find all your agreements, upload them to a provider who will read them, highlight them, extract all the data, enter it in, And then all you have to do is press a button and out will come your schedules, your journal entries, and your ACFR notes. So I will let that come up later in the conversation. There's a few other things before we end. We have one more polling question, and then Kelly and I are going to take some time and do some Q&A here.
All right. So last polling question. Have you started documenting a plan for ongoing compliance with GASB 96?
All right, let's go ahead and close that one, Connor.
All right.
And I can see there's about 45% of the people are yes. 55% of the people are no. I would tell you, take the plan from this deck, use it. Use the deck here. And so you've got your plan. So now you could all say yes, because you can just take the plan that we just presented to you and use that for getting started. The hardest part is just reaching out inside your organization and finding all of your agreements. That is your number one starting point. So I would encourage you to do that. And Kelly, any other advice on that from you?
Hurry up.
Hurry up.
Just get started and really, I mean, that's step one. That's documenting the path to completion. So if you need help with that, I know either of us can help. But it is important to get that ball rolling.
Yeah, my colleague Bill will reshare this. If you have questions for DebtBook, you can reach out to us at partnerships@debtbook.com. Kelly's going to share how to obtain your CPE, as well as some future LSL webinars and events that are coming up. And then she's going to hand it over to my colleague Bill to demonstrate.
Yeah. What is our time? 2 o'clock? Sorry, I'm Central. 2 o'clock my time. 12 o'clock California.
It is. Yeah, we have about 5 minutes to do Q&A. What we could do is go through the Q&A and write up the answers and get those out with the other materials later as well.
Sure. So real fast, just because it's housekeeping. If you answered all 3 of the polling questions, and I know many of you on the call are CPAs and need your CPE, it will, as Kimmy mentioned, it will come from Prolera. If you missed a polling question, you can email us at contact.us@lslcpas.com. If you need any assistance, you do need to complete the evaluation in Prolera in order to receive your CPE. If you need help, contact them, not us. It's a third-party platform. And then next slide. I want to invite all of you to LSL's GASB update. Some of you are already on our mailing list, so you'll get further details on this. It is May 4th. It's in Garden Grove, California. We're going to be doing our standard format where we do 4 different presentations, kind of in more mini sessions. It will be in person, but we will also be offering it live through live stream again this year. We hope to see all of you in person. We have plenty of space. So come and see us. Maybe I'll take you out for a drink after. Maybe we can just have lunch together. But come and see us. We'd love to catch up. So let's go through maybe a couple questions, and then I know we need to move to, I'm sure a bunch of people will drop off, and we'll go through, for those of you who are interested, I asked DebtBook to show you what a software solution looks like. I do have some clients on the call who are doing it manually, and you are brave souls. We did not have any major issues with our clients that were doing the calculations manually. But if you only had 2 or 3 leases and you have 200 SPIDAs, trust me, you don't want to do it manually. So I did ask DebtBook to stay on and kind of show how the software works as a software solution. A couple of the questions. I did have a question about whether or not invoices were okay to use if you can't find a contract. That's totally fine. Any information that you can provide. The key is we need to see something that shows it's 12 months or longer, or I should say longer than 12 months. It needs to be that more long-term, not short-term. I don't know, Louis, if you want to jump in on any of these either, feel free. going back into the questions.
Yeah, and for the ones we don't get to, we will go through them and try to write up answers, or you can reach out to DebtBook or to Kelly at LSL later as well. So I'm not sure which ones you've gone through or skipped here, but
one more I mentioned that you can absolutely do separate journal entries, but I want to explain it. So a lot of the clients, I did implementation for some of my clients, my consulting clients, and on the audit side, helped a ton of our clients as a subject matter expert, doing the journal entry piece of it and getting into your softwares. And the question came up whether or not you can maintain separate accounts. One for your budgetary basis, where it's really more showing that cash basis, and then another set for your GASB basis. That's exactly what I did for my clients, because I still wear that finance director hat. And to me, budget is still king. Unless I'm the auditor, then the financials are king. So absolutely fine. If you want to see what that looks like, I have a couple of examples. Just send me a message and let me know.
Ellie, here's one. It's and I'm going to share, some feedback that I get from a number of CPA firms, but is it a material weakness if your auditor prepares the note disclosure? So I'm going to tell all of you that some audit firms will and some won't, and some will say that they'll get you to sign off that, you made all decisions and all of that. I have a number of firms that will tell you that, hey, we're not allowed to help with the implementation of new accounting standards. We have to audit it. And so that sometimes you have consultants and sometimes you have auditors. But I'm going to let Kelly be the authority on that, because I believe whatever she says will be, in fact, the actual answer. I just know different firms will take different positions and they'll use materiality because of staffing levels, things like that.
So part of the answer is it depends on what state you're in. And for those of you, in fact, I know some of my Moses Lake folks are on the call. In the state of Washington, you have to have a already prepared act for draft before the state will start your audit. So in that case, yes, you need to prepare them and your auditors aren't going to do it for you. On the audit side, there are some accounting firms, to your point, Lewis, that say no, hard line. We look at preparing footnotes as a compilation, as taking pieces of data and just putting it into the format that needs to go into the footnotes. We're not doing the calculations. We're not responsible for the accuracy of the information. We're just pulling all of it together in the format that complies with the GASB. So we're actually okay with that. DebtBook has some really great templates, and Lewis mentioned when he was talking about the IBR calculations, the interest rates, that he'd be providing us with that spreadsheet. DebtBook has been a really great partner of ours. They've allowed us, even during GASB 87 implementation, for our clients who were doing the calculations manually, DebtBook allowed us to provide those clients with both the IBRs and the footnote templates, so that they had examples of how the information was calculated. And on some of my consulting clients where we're, more outsourced, doing some of the year-end close work alongside your team, we're actually using some of the DebtBook tools as well. So I think it's fine if your auditors are preparing the footnotes, just so long as they're not completing the underlying calculations that those footnotes are based on. There was a question about a JPA that uses its members' IT agreements. If you are the JPA and it's the member agency, so I'm remembering from my Seal Beach days, we were a member of a JPA, 3 parties. We were the ones that had the software system. The JPA would not implement GASB 96 for the software. The city of Seal Beach will. So depending on who actually has the contract, that's what you want to focus on. Who's truly financially obligated under that contract. What else?
There's a number of questions that are specific to individual agreements. And I think if you guys will just reach out directly to Kelly or to DebtBook, one of us will get you an answer on some of your more specific questions.
Yeah, before we hand it over to Bill, there was one question, and I'm not seeing it here, but I remember it. The question came up, if it's a year-to-year agreement that continues, even if it renews annually for the next 10 years, and you have to make the determination of the likelihood of it terminating, whether or not it would fall under GASB 96. One of the things that I worked really closely with Casey on the DebtBook team for 87 is that reasonable likelihood and whether or not it truly does trigger the standard to come into play. We actually posed the question to GASB and asked for an official ruling because it was something that we were having a lot of issues with. If they've had this restaurant leasing a space for 40 years, but we have to make this determination and it's truly only a year-to-year agreement, it doesn't feel right to not consider that a lease because they've been in that space for so long. The question is in here related to GASB 96 as well. The GASB ruled in that instance, even though we think of substance over form, in this instance, these two GASBs were created to give the users of the financial statements an understanding of your organization's financial commitments. If you are not financially committed and you have to pay those, even if you terminate early, then it doesn't comply under the standard. And when I understood, think of your budgetary side. If I'm not required to budget 3 years from now, because I do have the option for it to terminate, then I shouldn't include it, even if that restaurant has occupied that space for the last 40 years. So if you have specific questions, reach out to your auditor or reach out to us. But that was one of the things that we really did focus on last year that applies here. And we did get that official ruling from GASB. So we'll go through, go ahead, Louis.
I was just gonna say, we will send you, Kelly, we have some assets around a list of common subscriptions for local government, a list of common subscriptions for schools, K-12 public schools. And we also have an inventory list for you to start as you aggregate your subscriptions where you can start to list them out.
That'd be great.
And put them together. And then we have some other GASB 96 resources. I will have Connor send all of that over, Kelly, to your team. And so as all of these assets get sent out after this webinar, all that can be available to everybody on the call as well.